Everyone, thank you for joining tonight's presentation on building wealth with real estate. And as you saw in some of the information we put out, we'll also show you how you can cash flow over $100,000 a year tax free. We're going to cover a lot of information this evening, including investing in real estate, to how your taxes are affected based on the way you invest, and many other unique strategies that you can utilize as a real estate investor to build your wealth, and more importantly, to build it in the most tax efficient manner possible. So with that, let's get into tonight's presentation. A couple of things I want to share that were also typed into the chat. If you have any questions tonight, please type those questions into the chat, and I'll be sure to answer all questions at the end of tonight's presentation. I'll still stay on till they all get answered. And the second thing is, if you have any questions after tonight, or if you'd like any assistance in real estate, please reach out at patrick.kappel@compass.com, which is also within the chat that you see within your window. So let's go over a few things that we're going to cover tonight. First off, we'll talk about the different forms of real estate cash flow. There's a big misconception out there that cash flow from real estate is limited to only that which you get every month from your tenants. There's numerous forms of cash flow beyond the rent that you get every month from tenants. And I'll tell you up front that the worst form of cash flow to get is the rent you get from your tenants. And there are much more better and efficient forms of cash flow to get out of real estate that we'll talk about later tonight. We'll go through different tax structures as well, and how different forms of real estate cash flow are taxed in different ways, and how you can use that knowledge to your advantage to build your wealth faster. Then we'll go through not just one, but three different case study examples on utilizing 1031 exchanges, long-term capital tax deductions, and also we'll cover how you can utilize cash out refinances to get tax-free cash flow. And we'll close it out tonight by talking a little bit about depreciation, bonus depreciation, and how depreciation actually translates into cash flow for you as an investor. And of course, we'll close it out with some Q&A. So with that, I always like to start my presentations by advising that no matter what direction you go with real estate investing, you need to have a team around you. And part of that team is a qualified CPA. The moment you start buying real estate is the moment you certainly should be working with a CPA when filing your taxes. Everyone's tax situation is different. We're all in different income levels. Some of us live in different states. You might own real estate in different states. So certainly ensure that when you do invest in real estate, you have a CPA who's not yourself doing your taxes, but somebody else helping you and advising you. Speaking of that team, I also run a team of real estate professionals that help both home buyers and real estate investors. The name of our team is Kappel Realty Group. Within the Kappel Realty Group, I have over 15 years of experience in the San Diego real estate market. I personally own 8 different investment properties in San Diego. I've also invested out of state in both Texas and Colorado, Missouri. And I got to tell you, the state that consecutively provides the highest real estate returns has always been California. In my opinion, as a guy who has invested for over a decade in multiple states, no state gives you better returns than Southern California. As you can see on the left, I'm also a board member of the Southern California Apartment Association, now known as the Rental Housing Association. My team and I, we have sold over $500 million in real estate in San Diego in just the last 5 years. And I say that just not to show the depth of our team, but to show that we really do know what we're talking about when it comes to real estate. And as you also see, I still serve in the Navy as a lieutenant commander in the Navy Reserves. I've now been in the Navy for 24 years. In fact, the Navy is what got me started in real estate. Like many of you that maybe haven't yet begun investing, I had a good mentor when I was in my 20s. And my mentor said, Patrick, buy real estate as often as possible and never sell it. So I started buying real estate when I was in my mid-20s, a young officer stationed in San Diego. And in between every military deployment, I would save up a little bit of money and I would buy another property when I'd come back off that deployment. And by the time I turned 40, I owned over 8 properties worth well over 10 million just in San Diego. And I learned by doing, but I also wanted to learn through an education. So you can see the education in the center there. I have a master's degree in real estate from USD, coupled with an MBA focused in finance at UCLA and a bachelor's from the US Naval Academy. So combining that practical experience over the last 15 years and the education, I'm going to share with you a lot of information you need to know as a new investor or as a seasoned investor. And last kind of introductory slide, again, if you have any questions after tonight, reach out to me at patrick.kappel@compass.com, and I'll be more than happy to help you out on your investment journey. So let's start out by discussing how to cash flow $100,000 per year. In fact, tax-free. I like to use quotes, and the one quote you're going to see tonight is this. Robert Kiyosaki. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. Robert Kiyosaki, as many of you know, is the author of Rich Dad, Poor Dad, a book that if you haven't read, you certainly should. And taking this into consideration, the quote we just read, let me ask you a couple of questions to frame tonight's topic and to frame your mindset. How would you rather make $500,000? Would you prefer to make $100,000 per year for 5 years, taxed at 32%? Or would you rather make $0 for 4 years, and then on year 5, make that same $500,000, but taxed at 0%? And the question here becomes very obvious in how you want to answer it. Unless you need the money immediately, you're probably going to want to take that money as a lump sum in 5 years, taxed at 0%, because you end up with a lot more. In fact, you end up with well over $100,000 more money if you can collect it as a lump sum in 5 years at a 0% tax rate. The problem is most people are allured by instant gratification. If you want to be a good investor, you need to learn to control your urges and be able to live without instant gratification, knowing you'll get greater gratification in return. You see, most people want that immediate cash flow, month one, year one. But I'm going to show you how you will become far wealthier over your lifetime if you can avoid instant gratification and wait till that year 5 in this example to get the full 500,000 instead of settling for 340,000. Because you see, Uncle Sam, our government, loves your rent checks. We all know that taxes are inescapable. And as much as Uncle Sam, though, loves your rent checks, he will stay away from your appreciation. You see, the government does not tax appreciation. Now, there's certain events that can happen where the government will tax it at a low tax rate, but there's other ways you can manage your real estate investments so that Uncle Sam never, ever taxes your appreciation, even beyond your death. And I'm going to teach you how to do that. But now keep in mind, as I note at the bottom here, both of these provide cash flow. And again, as I started, most people have the misconception that the definition of cash flow when it comes to real estate is that monthly rent that you're getting from your tenants. But the truth is there's multiple forms of cash flow that we'll get into tonight. And as we see in Investopedia, cash flow is simply the net amount of cash and cash equivalents that are transferred in and out of a company. So your company in real estate is the property itself. Any cash that comes out of that property to you is cash flow. So in real estate, cash flow is what we call a liquidity event. So what is a liquidity event? It's any event in your real estate investment that causes a property to pay cash out to the owner. It can be things beyond monthly rent, but as I mentioned, that's the most common one that people think of first off. Next, you can get it from a property sale, pretty obvious. Third, you can get it from what we call a 1031 exchange. We'll dive a little bit into that tonight. Fourth, You can get it from a cash out refinance. Maybe it's because I grew up in a farming community in the Midwest when I was a kid, but I like to call a cash out refinanced harvesting your asset, harvesting the asset. Now, these, some are good, some are bad. I'm not going to say any of them are bad. Some are better than others in the eyes of the government and the eyes of the tax system. You see, monthly rent on average can get taxed 32% or even higher, depending on your individual tax bracket. Next, the sale of a property, you're going to get taxed anywhere from 0% to 15%, depending on your tax bracket, maybe even up to 20%, but no more than 20%, as long as you've owned that property for at least a year. With a 1031 exchange, on average, we see most real estate investors pay 0% in taxes. And with a cash out refinance, 0% in taxes. So what if I told you no matter where you invest or what you invest in, you're going to get about the same return? The major difference based on what and where you invest is going to be how that return is taxed. Knowing that if you make $100,000 in the Midwest, 100,000 on the East Coast, or 100,000 on the West Coast in California, would you rather get taxed at 32, 15, or 0%? And I don't know about you, but I prefer getting taxed at 0%. So let's dive a little bit into the tax law and what I mean by this. Now, most people in America work for what we call ordinary income. And you might have not thought you're going to get a little bit of a tax lesson today, but you are. Because the wealthy build their fortunes through long-term capital gains. So what's the difference between what most people do, making money off ordinary income, and what the wealthy do, building fortunes through long-term capital gains? Well, there's a major difference, and it comes down to the way the money is taxed. You see, in the United States of America, we have two tax systems. Some people would say it's a tax system for the wealthy and then a tax system for everyone else. I would say it's a tax system for the informed and a tax system for the uninformed. And most people, including many real estate investors, never take the time to inform themselves on how money is taxed. And they certainly don't take the time to inform themselves and educate themselves on the different ways money is taxed based on how you make it, including how you make it in real estate. So let's talk about the differences and how your money is taxed. Let's say, for example, person A. For every $100 person A earns, they're taxed at 32%. For every $100 person B earns, they're taxed at 0%. Who do you want to be? Again, I don't know about you, but I'd rather be person B, especially knowing they're both making about the same amount of money over the lifetime. And who's going to end up wealthier? Obviously, person B. In fact, when we look at these two examples, let's say you take $100,000 and you place it into an investment that gives you an 8% return. Over 30 years, the $100,000 invested into an account with an 8% return at a tax rate of 32%, you will end up with $489,961. The other person, though, person B, takes the same $100,000, invests it into an asset, gives the same return, 8%. But that return is not taxed. Person B ends up with well over $1 million, over 2 times more wealth than person A. Understanding the tax code and investing with an understanding of it can change your net worth by over 2x over your lifetime. And the tax code plays into real estate investing more than any other type of investing. There are probably more tax code laws and, let's call them what they are, loopholes on real estate than there are in stocks, bonds, retirement accounts, or just about anything else. So having said that, let's take a little bit of a look at what is ordinary income and what is long-term capital gain. In other words, what are these two tax systems that I'm talking about, and how can you use them to your advantage? Well, ordinary income is taxed at the highest tax rate in America. And it includes many things, including the money you earn from your job. This is probably the most basic tax code most people understand, and it's the income tax rate. The income tax rate is the exact same thing as short-term capital gain, exact same thing as ordinary income tax rate. It's money earned from your job. It's cash flow from dividends, like dividend paying stocks, and it's also rental cash flow from investment real estate. So the rental income that you get from real estate is taxed at this high tax rate. Now, a lot of times people invest and they will say, hey, Patrick, I want a property with a high cap rate. And what those people don't understand, typically novice investors, is that a high cap rate property usually is in a marketplace that has low appreciation. And conversely, real estate with high appreciation usually has low cap rates. You don't know what cap rate is. It kind of, in a roundabout way, higher the cap rate, the more your monthly cash flow. Something definitely to know if you're a real estate investor. Well, why do I draw the analogy? Because those folks investing for high cap rates are also investing to pay the highest tax rates. On the contrary, you have long-term capital gains. This is our other segment of the tax code. Long-term capital gains, by definition, is the gain you make on anything, any investment that you have for over 12 months, over 1 year. Now, the long-term capital gain tax rate, as you can see, is much lower than the ordinary income tax rate. It's 0 to 20%, about half of what the ordinary income tax rate is. So what qualifies as long-term capital gain? Certain investment assets that, again, you've owned for over 12 months, as well as the appreciation of real estate that you've owned for over 12 months. So knowing these basic two tax systems, if you're an American citizen, which tax system do you want to operate in? The one on the right. Which tax system is going to make you wealthier over the long run? The one on the right. And as my sister tells me, there really are two tax codes in America. There are. But for the informed, and then the one on the left is really how most Americans work, and most Americans don't understand this tax code. Now, what you're looking at in front of you is a bit of an eye chart. So let's look at this for a moment because it's important to understand. You're looking at the two tax codes, the two tax tables in America in front of you right now. And you're looking at the one on the left and the one on the right. The one on the left is if you're a single person, you're not married. The one on the right is for married people filing jointly. So let's take a look at these tax tables. And you can see as a single person making up to $11,000, your short-term capital gains tax rate, your ordinary income tax rate, is taxed at 10%. Your long-term capital gains is taxed at 0%. Once you make over 11,000 up to 44,000, you're taxed at 12%. You're still, for long-term capital gains, taxed at 0. And it keeps on going up in such a manner that your long-term capital gains tax rate never goes above 20%, whereas your short-term capital gains tax rate goes up to 37. Let's look at the same thing for the married couple. In fact, for the married couple to really dive into this, let's zoom in and take a look at these two different tax rates. So let's say you're married, you got a husband, wife, a spouse, and you're wondering, how should we invest our money? Well, I'm going to tell you right now, with your job, no matter what your job is, maybe you're a doctor, lawyer, nurse, maybe you work the checkout aisle, maybe you're like me, you work in real estate. Whatever money you make from your job, you're getting taxed on the left. Short-term capital gains tax rate. America really does tax people that work the highest tax rate. Now, when it comes to investing, you and only you get to decide what you're going to invest in, and thus only you get to decide which one of these two tax tables are going to apply to you and you're going to play in. Now, if you want to invest in real estate that provides you high monthly cash flow and a high cap rate, let me be the first to tell you, you're working in the tax table on the left. And all of that high cash flow that you're getting is getting taxed at these high tax rates. And as I mentioned earlier, typically markets like the Midwest where you have high cap rates, high cash flow, you have low appreciation. Now, if you do what I've done my whole life and you decide that you'd rather invest with the mindset of being taxed as little as possible, you'll invest aiming for the right side of the column, the long-term capital gains tax rate. So when it comes to real estate, how do you consciously make this decision? You consciously invest in markets that have high rates of appreciation. Because as I mentioned, appreciation falls in on the right side, monthly cash flow falls in on the left. And as we can see, if you're investing for long-term capital gains, i.e. appreciation, your first up, you can make up to $89,000 and not pay any taxes. You can make $89,000 up to over $500,000, $553,000, and still only pay a 15% tax rate. Anything you make over $553,000 is taxed at 20%, and that's where it's capped. You can make $5 billion next year as at a long-term capital gain, and you get taxed at 20%. There is a 3.5% add-on for couples that make over 125,000 through their income, but that's not going to apply to everyone. And 3.5 added on still ensures that your long-term capital gain tax rate is extraordinarily smaller compared to your short-term capital gains tax rate. Now, some people might say, well, appreciation is not as guaranteed as rental income cash flow. As a guy who's been investing for 15 years, I would disagree with that statement. When you invest for appreciation, you are investing based on macroeconomic trends in a marketplace. And if you're investing in San Diego or Los Angeles or Texas or Colorado or New York, you had better understand those long-term economic trends in your marketplace, or you're not a wise investor. So I'm going to assume you know the long-term economic trends in the marketplace you invest in. When you invest for monthly cash flow, you are investing then instead of one individual human being, a tenant who you barely know, and you're hoping they pay you every month. And I have learned over a decade and a half that I will rather bet my money on long-term macroeconomic trends than bet my money on one renter that I barely even know and hoping that they pay rent. And as I also mentioned earlier, typically those markets that have lower cap rates have higher appreciation. Now, for those who invest for long-term capital gains, those who invest for appreciation, there are numerous ways to make an infinite amount of money and not even pay the long-term capital gains tax rate. In fact, there's ways to invest in real estate and make a boatload of money and not pay any taxes on that long-term gain throughout your life and even after death. So let's get into those. Now, there's 4 main ways. One is the owner exclusion, also known as occupying the property 2 out of the last 5 years, and we're going to dive into that in the next slide. The second way is a cash out refinance. Again, I call that harvesting the asset, and we'll go through an example of that as well. Next is a 1031 exchange, trading up. And the fourth is a step-up cost basis, kind of tied into all of these. We'll cover a slide on each one, but let's start out with your owner exclusion. This applies to anyone who has lived in a property for 2 out of the last 5 years. The property doesn't have to be the one you live in today. It doesn't have to be your primary residence. It just has to have been your primary residence for 2 out of the last 5 years. So maybe you lived there for 2 years and then you moved out for 2 years and now you want to sell it. Well, you've lived in it 2 out of the last 5 years, it applies. And if you've lived in a property 2 out of the last 5 years and you're single, you can sell the property and your first $250,000 in a gain is all tax-free, 100%. If you're married, your first $500,000 in a gain is all tax-free. We have a client do this probably about once every few months. A client that will maybe have lived in a property for a while and they're selling it now. They can, and maybe it's a rental. Maybe they live on the East Coast, but because they lived in it 2 of the last 5 years, they can make up $500,000 all tax-free. 2 out of the 5-year exclusion. The second, and this is probably one of my favorites, the cash out refinance. So how does a cash out refinance work? And for all these 2 guys, we're going to do some case studies. But really just the big overview of a cash out refinance. Let's say you buy a home for, I don't know, $400,000. You bought a home for 400,000. You've owned it for some time, and now your mortgage balance is 300,000. Well, you've got some equity in it, and you bought it years ago for 400,000. Now it's worth 500,000. So you got this home that's now worth 500,000, and your mortgage balance is 300,000. You can replace your current mortgage with a new mortgage. It's not a second mortgage you're getting so that you have two mortgages. You're still always going to have just one mortgage. But think about this, guys. If your home is worth 500,000 and your current mortgage balance is 300, you can go to the bank and get a brand new mortgage on your house for $400,000. We would call that an 80% loan to value. 80% of your home's value is tied up in a loan, 400,000 out of 500,000. Now that you got that new $400,000 mortgage, the new $400,000 mortgage pays off the existing balance of your $300,000 mortgage. Well, what's 400,000 minus 300,000? $100,000. So after paying off your old mortgage, you have $100,000 left over from that cash out refinance. What do you do with that money? Put it in your pocket, put it in your bank account, use it to invest in more real estate. But either way, that money is your money and you got it tax free. This is why we call it a cash out refinance, because you're not just refinancing your house to get a lower interest rate, you're refinancing your house and pulling some cash out of it. The thing I love about this, it allows you to keep your house, or maybe it's a duplex, maybe it's a fourplex, an apartment building, but it allows you to keep your property, keep operating as you have been, and pull out hundreds of thousands of dollars potentially. And the best part is the government does not tax that money at all. So you just pulled out $100,000 tax-free. Next, the 1031 exchange. So what is 1031 exchange? It's a section of the IRS tax code, section 1031. What does this section allow you to do? It allows you to buy a property, and if it's an investment property and you sell it at a gain, in other words, you sell it for more money than you bought it for, if you utilize the proceeds of your sale to buy a new property of equal or greater value, then the proceeds of your original sale are all tax-free. So let's use an example. Let's say you live in San Diego and you want to buy your first investment property. You buy a $500,000 condo. You own that property for 5 to 10 years. It goes up in value. You sell that condo, let's say for $800,000. You just made $300K. And let's say you take the $300,000 you gained and you use it to buy $1 million duplex. In doing so, you completely escaped having to pay taxes. And you don't pay any taxes on the gain you made on that investment condo. And you now own a duplex for $1 million, and you didn't have to put any new money into it, just the money you got from your sale, tax-free. You own that duplex for 5 to 10 years, it goes up in value, you sell it, and instead of putting the money in your pocket, you use your proceeds to buy a triplex. You own the triplex for 10 years, it goes up in value, you sell it, and you use the proceeds to buy a fourplex. You own that, and you use the proceeds to buy a fiveplex. And as you can see, every time you sell a property, if you utilize your proceeds, your gain, to buy another property of equal or greater value, you pay zero in taxes. So you might think this is well and great, but what happens when you've done this your whole lifetime? Now you're 95 years old, you've lived a good life, and you're going to leave this property to your kids. Well, if you sell that $2.5 million apartment building while you are alive, or any day before you die, you will pay capital gains taxes on about $2 million because you went from 500,000 to 2.5 million. At least you're paying capital gains taxes and not ordinary income tax rate. So you're paying a much lower tax rate. But you're smarter than that, and you don't want to pay any taxes. You want to beat Ben Franklin. And why do I say that? Because Ben Franklin said two things you can't escape in life are death and taxes. I disagree with Ben Franklin. And it's not that he wasn't wrong at the time. He was probably right at the time he lived in. But Ben Franklin did not live in the tax code we have today. In the tax code we have today, you certainly can't escape death, but you can escape taxes. If you own this property, 2.5 million, and then you die and you leave it to your children inherit the property, and the IRS gives the property what is called a step-up cost basis. So to really explain it in layman's terms, the IRS pretends that your children acquired the property for $2.5 million. Now, of course, you acquired it through a $500,000 initial purchase, and then you kept 1031ing up until you died. And if you sold it before you died, you would owe taxes on $2 million. But instead, you left it to your children. Your children inherited this apartment building worth 2.5 million. They went to your funeral, and after your funeral, they go sell this apartment building, and they can sell it for 2.5 million and not pay any taxes. Because in the eyes of the IRS, they inherit it for 2.5. They sell it for 2.5. They didn't make any money. When you and I know the truth is, they and you made $2.5 million tax-free. That's the beauty of the step-up cost basis. And this is how wealthy families pass millions and millions of dollars onto their children tax-free. This is how generational wealth is created. Now, I know what you're thinking. You're probably thinking the same thing I'm thinking. You're thinking, I love my children, but I want to spend some of that money before I die. And I want to enjoy it before I die. Well, you combine this strategy with the previous one we talked about, cash out refinances. You see, all along, while you're selling a single family for a duplex for a triplex for a fourplex, and you're making all of these moves tax-free, and you're gaining all of this wealth tax-free, you don't want to wait till you're dead to sell it and enjoy the money. You want to enjoy it while you're alive. So all the while, you harvest the asset through cash out refinances. By the time you get to this $1.5 million purchase, you got $1 million equity in that bad boy. You might as well cash out refi $500,000 and go on that vacation you always wanted to go on. And oh, by the way, that cash out refi, all tax free. So throughout your life, you're pulling money out of your assets tax free. When you die, you leave to your children multi-million-dollar asset tax free. And all the while, no one's having to pay Uncle Sam because you're making your wealth through appreciation, not through monthly cash flow. So let's go through a couple of real world examples where we had some clients do this very thing. Case study number 1, 1031 exchange. I had a client who bought a duplex in North Park on Georgia Street, bought it in 2014 for $726,000 and bought it with 0% down because he bought it with a VA loan. And when you use your VA loan, just about any loans, you can buy 1 to 4 unit properties. With a VA loan, you don't have to put down anything. He sold it 6 years later for just over $1 million. So there he goes. He gained $295,000, but he gained it tax-free because he did a 1031 exchange. As we just discussed, he took his proceeds and he rolled it into the purchase of a property of equal or greater value. In this instance, he sold the duplex and used his proceeds to buy a fourplex. And he bought a $1.05 million fourplex down in Imperial Beach. Now, he owned this for a couple of years until 2022, when it appraised for $1.55 million. Now, mind you, this guy started out with $0 because he used his VA loan to buy that duplex. So now, less than 10 years later, just 8 years, he owns a $1.55 million asset. He started with a $726,000 asset. So he has now gained $824,000 in equity, growing $0 to $800,000 over 8 years, all tax free. And he did this through 1031 exchanges, starting with $0 using a VA loan. He can turn that $824,000 of equity into cash flow through either a cash out refinance, or B, he could do it through a sale of property, we're going to pay a long-term capital gains tax rate, but at least that's much lower, as we showed in previous slides, than the short-term capital gains tax rate. Then we go to case study number 2. Case study number 2, we're starting out with a triplex. Now, this triplex was purchased in 2020. We all know what was going on in 2020. It was the start of the global pandemic. Because it was the start of the global pandemic, the buyers of this property, two young naval officers, many of their friends and their family said, it's a bad time to buy real estate. There's a global pandemic that just started. You shouldn't buy real estate. The truth is, though, all their family and their friends that said it's a bad time, they don't work in real estate. They don't understand finance. They don't understand investment real estate. My team and I told them it was a great time to buy. In fact, I ended up buying a lot of real estate in 2020 because of the economic fundamentals that were presenting themselves. So we told these guys, good time to buy. Don't listen to your family. Don't listen to your friends. Listen to them when it comes to maybe relationship advice, but real estate advice, don't listen to your family and friends unless they work in real estate. It's kind of like when I need medical advice, I don't talk to family and friends unless they're medical professionals. When you need real estate advice, talk to real estate professionals. So these guys took our advice. They bought this property that cash flowed $0 on rent, even though it was fully rented up, no cash flow. But we explained to them the different forms of cash flow and they understood it. So what happened for these two young naval officers? They sold it just 1 year later for 1.3 million. Thank God they didn't listen to their family and friends, because they made over $400,000 in just over 12 months. And although they sold it, they didn't get to avoid taxes. They didn't do a 1031 exchange like we talked about in the last example, but they only got taxed at the low long-term capital gains tax rate below of 15% and less. They didn't even get up to the 20%, just 15% or less, lowest tax rate they could ever have to face, instead of the 32% tax rate that many people face when they invest for immediate cash flow. Now I'm going to share with you one more case study that goes back all the way to 2012. This involves a house in Point Loma. So for this home, bought for about $700,000 or so, officer and a nurse. And again, many of their friends told them it was foolish to buy. And how do I know it? Because I was the person who bought this. I wasn't even in real estate when I bought this yet, guys. I was an officer in the Navy still. And all my friends and all my family said, you're crazy to spend almost $700,000 on a house. This is back in 2012. The great financial crisis was going on. In fact, my wife and I went from paying a $2,000 a month rent to over $4,000 a month in mortgage. We doubled our payment. So how could we have been so crazy? Because I was listening to my mentors who understood real estate and gave me the advice. So what happened over the next 10 years? Well, I started combining a lot of the things we talked about tonight. In 2015, it was valued at 1.1 million. It had gone up about $400,000. I did a cash out refinance and pulled out $400,000 tax-free. All that money, I rolled most of it back into the property and did a massive floor to ceiling renovation down to the foundation. We renovated that house from what you see in the top to the photos you see in the bottom. Same kitchen, just a little bit different layout, better finishings. Same house, added some square footage on the left, as you can see. That increased the value of the house. So by 2017, that home now is worth 1.6 million. So what did we do? We did another cash out refinance, pulled out $300,000 on this cash out refinance. And I used that $300,000 as a down payment to buy a duplex in Linda Vista on Westinghouse Street. So here I am now buying a duplex, really with no money out of my pocket, didn't have to work for it. And I didn't pay taxes on that $300,000 gain. So fast forward a few more years to 2020. Now we're at the pandemic. Remember, I said I did a lot of real estate in 2020 as far as buying stuff myself. And I bought one of the more expensive properties I bought in 2020, a fourplex by the beach in IB. How'd I buy that? Another cash out refinance on that house. Pulled out another $300,000 and put it down on the purchase of a fourplex at 234 Date Avenue for about $1.3 million. Now you might be thinking, well, with all these cash out refinances, I started with a $700,000 purchase, pulled out $1 million. My mortgage balance must be much higher. My mortgage balance is much higher. But you know what else has gone up in the last 10 years? Rents and property values. So now we get to 2022, just 2 years ago, and it got appraised for 2.2 million. And I moved out of this house and I turned it into a rental. And even with all these cash out refinancing, pulling out $1 million through the cash out refinances, having a much higher mortgage balance, the property is still the rent is still covering the mortgage 100% plus $1,000 extra. If that's not a success story, I don't know what is, but it shows the value of how if you invest intelligently and invest for appreciation and you understand the macroeconomics of the market you invest in, you can make a lot of money tax-free. In fact, when you go back on this deal story over the last 10 years, you see $1.5 million of growth tax-free. You see $1 million in cash flow tax-free over a 10-year period, which equates to $100,000 per year on average tax-free. And I don't know about you, but if you're going to cash flow $100,000 a year, I'd rather make it tax-free than pay 32% plus tax rate on it. Next, I'm going to close it out with one last item that you need to be aware of as a real estate investor. That is depreciation and something new that came along in the last few years, bonus depreciation. So what is depreciation? By definition, it's the decrease in value of assets and the method used to reallocate or write down the cost of a tangible asset, such as equipment over its usable lifespan. How do I explain this in layman's terms? Let's say you buy a building like the brown fourplex you see in the photo in front of you, this IB property in IB. If you buy it for $1.3 million and the land has value and you can't write down the cost of land, and the building has value. Let's say the building has $800,000 in value and the land has $500,000 in value. That land is still going to be there 1,000 years from now. The building is not going to be there 1,000 years from now. So the IRS allows you to write off the cost of the building over a period of time. Now, the $800,000 cost of the building, we don't have to wait 1,000 years to write it off. We don't have to wait 100 years. The IRS lets you write off the cost of the building, that $800,000, over 27.5 years. So how does that look? Well, you can see here on the far left, the cost of the building, I'm circling with my cursor, $800,000, 27.5 years. I bought it towards the end of a year. So actually about midway through the year in July. So if you divide 27.5 into 800,000, you get about $29,000. $29,000 times 27.5 years is about 800,000. So what does the IRS allow us to do? Does the building go down in value? No, it does not. Does the IRS allow you to pretend the building goes down in value? Yes, it does. And it allows you to pretend the building goes down in that value over 27.5 years. This is why we divide the 800 by 27.5 and get about 29,000. So even if the building doesn't lose money, the IRS lets you take a $29,000 tax deduction every year. Well, wouldn't it be better if you could pull forward these tax write-offs and write the money off sooner in year one, in year two? The sooner you can take a tax deduction, the better, right? You don't want to wait 20 years to take a tax deduction that you can take today. And this is where cost segregation studies come into play. So when you buy a piece of real estate, the IRS says the building can be depreciated, written off over 27.5 years. But there's improvements attached to that building that you can write off sooner than 27.5 years. Improvements might be things like carpet, plumbing, maybe kitchen cabinets, washer and dryer, the fence in the backyard, and the driveway in front of your garage. These are all improvements beyond the building. Some of these improvements, you can write them off in 5 years, some of them in 7, some of them in 15 years. So as you can see here in the top right, the building total was $800,000, but of that $800,000, we were able to allocate $154,000 to property aspects of it that you can write off in 5 years. $46,000 we were able to allocate to stuff you could write off in 15 years. Being able to take these tax deductions sooner is as good as putting money in your pocket. Because going from owing Uncle Sam $10 to now owing Uncle Sam $5 is like putting $5 in your pocket. Because you owe him $5 less, you get to keep that money. In 2017, there was a new tax law that was passed. It's called the Tax Cut and Jobs Act. And in 2017, Congress passed a law that said anything you can depreciate in 20 years or less, you can instead depreciate it immediately, the year you buy the property. So what did that allow us to do? That allowed us, the year we bought this, 2020, this 5-year, $154,000, in the 15-year, $46,000, we got to write that off the year we bought it. And the $599 divided by 27.5, halfway through the year, gives you $11,000. If you add these three up, it ends up being a $212,000 tax write-off the year the property was purchased. Now, let me be clear. Did I lose $212,000 the year I bought this property? Not at all. Did I have a $212,000 loss the year I bought the property? Not at all. But did I get to put a $212,000 tax write-off on my tax return that year? Absolutely. Because of bonus depreciation. Bonus depreciation began in September 2017. It began sunsetting in 2023, and it'll continue sunsetting over the next few years. What does that mean? That means it still exists. You can still use bonus depreciation. It's just a little bit less powerful each year going out the next few years until about 2026, 2027. But again, as mentioned, owing less in taxes, getting these, let's call them what they are, made up tax write-offs that the IRS allows. They're made up by the IRS, I guess. They keep money in your pocket and they put money in your pocket. In fact, you can see by having that additional tax write-off, in year one, we had an additional $197,000 tax write-off. And that increased our cash flow by $84,438 because that was $84,000 we didn't have to pay in taxes that we otherwise would have had to have that year. And money that you don't pay, again, back to Ben Franklin, I guess, a penny saved is a penny earned. Money that you don't have to pay out is money you earned. So I'm going to close it out before going into Q&A by ending where we started. Cash flow. What is it? It's not just the money you get from rent. Numerous forms of cash flow. Cash out refinance, 1031 exchanges, step up cost basis, 2 out of the 5-year exclusion. And you heard my favorite ones, the cash out refinance. But cash flow is the net amount of any cash or cash equivalents being transferred in and out of a company. That's the definition of cash flow. It's not just the monthly rent you get from a tenant that you don't even know. It's the cash flow you get from numerous types of activities. The biggest difference, though, and you determine this, is how is it going to get taxed? Would you rather make $500,000, $100,000 a year, taxed at 32%? Or would you rather make it all in one windfall at year 5, taxed at 0%? The way you answered this question tells me as a real estate professional what type of property you want to invest in. A lot of people don't realize, though, that in markets like San Diego, where you have high appreciation, low cap rates, in other words, low monthly cash flow, you have that high appreciation effect because of the limit of supply. Whereas in Midwest markets, where you have unlimited supply, you can just keep building and building in the Midwest, you're going to have much higher monthly cash flow because you have much lower appreciation. And let me be very clear when I say this. Markets that have high cap rates, properties that have high cap rates, they don't have high cap rates because they're good investments. They have high cap rates because they're bad investments. And because they're bad investments in so many other regards, to make up for the fact it doesn't have high appreciation, to make up for the fact it's a risky investment, the property has to have a high cap rate to make up for the lack of return in other areas. Properties and markets that have low cap rates because they're good investments and they're giving you that return in other means that are much more tax efficient. With that, I'll close out by saying, in order to cross the finish line, you must first cross the starting line. And what do I mean by that? I meet a lot of people that I call wannabe investors, but they never become real investors because they're looking for that deal that never exists, the unicorn. The unicorn deal doesn't exist, guys. The best deal to buy is the deal that gets you started, the deal that gets you moving. Certainly a deal that you don't go bankrupt on, but the deal that gets you going. I've met so many people that want to cross the finish line. They want to be financially independent. They want to grow wealth through real estate, but they're too afraid to cross that starting line. So I'll tell you what the starting line looks like, and it's not as scary as it seems. It looks like a one-on-one sit-down consultation with myself and one of my team members. So if you're out there and you're thinking you want to learn more or you want to start investing in real estate, but you don't know where to start and you don't know where the starting line begins, feel free to reach out to me, reach out to my team. We'll be happy to sit down with you, an initial 60-minute meeting, so we can learn more about you, you can learn more about us, and how as real estate brokers, we can help educate you and guide you on your path to becoming a successful real estate investor. But at the end of the day, as the slide in front of you says, who you work with matters. And I can guarantee you, most people in real estate don't really understand real estate. It's kind of scary, but it's true. And I can guarantee you, when you work with my team, you are working with real estate professionals and real estate agents that not only understand real estate, but eat, breathe, and sleep this and own real estate themselves. So if you're looking to begin on that journey, feel free to reach out to me. My email address is in the top, patrick.kappel@compass.com. And I also encourage you to check out our YouTube channel. If you go to YouTube and simply type in Kappel Realty Group, you're going to find dozens of other webinars that include things like real estate and economic updates, how to get your down payment 100% covered by the state of California through some of the new grant programs that are around this year, how to invest in 2 to 4 units, how to house hack, and many other real estate webinars. Just check those out on our YouTube channel by typing in Kappel Realty. I got a couple of questions, so let me get on the questions. The first one says, can you do a video on tax write-offs and what type of expenses with owning real estate and how it helps during tax season? I understand you're not a CPA, but on the educational side. If any of you are my clients, then give me a call, shoot me an email, and we'll set up a one-on-one meeting on various tax write-offs that you can do through real estate. And to be bluntly candid here, I make no money by doing these educational videos. I make my income, I make my livelihood by working in real estate brokerage. And this is why my clients and my team's clients certainly get education and access to us beyond these videos. So if you're one of our clients or you want to become one of our clients, let me know. You'll get a lot more education and access to information beyond what we cover in these videos, beyond what's on YouTube. And you can reach out to me at any time for a 60-minute one-on-one sit down. No charge, of course. And we'll talk about all the write-offs that I use myself when I invest in real estate. Next, I got a question asking if this video is going to be on YouTube. Yes, absolutely. After tonight, I am going to upload this video on our YouTube channel. It'll be there within the next day or two, and you can rewatch it. If you have any friends or any family that would like to learn some of this information, please share this YouTube channel with them. I got another question here asking, can you write off bonus appreciation for the years you lived in the property if it's now being rented? I think what the question is, can you write off bonus depreciation for the years you lived in a property now it's being rented? And the answer is yes. If you live in a property, now bonus two things I want to cover on this. Bonus depreciation is dependent on when you bought the property, guys. If you bought a property between September of 2017 and December 31st of 2022, you get 100% bonus depreciation. If you bought it in 2023, you get 80% bonus depreciation. You buy it this year, you get 60%, and so on and so on. Now, let's say you lived in a property. Does bonus depreciation apply to the property? It depends on the year you bought the property and placed it into service. But let's say an example like the house I showed you that I bought for $695,000. I lived in it for 10 years, and then I turned it into a rental. I tracked all the expenses tied to that house. I tracked how much I paid for the house. I tracked money I put into it, my renovation costs to improve it and make it better. And that increased my basis on that property. Your basis of a property is how much you bought it for, plus how much capital improvements you put into it. So you keep on putting capital improvements, even if you're living in it, you're increasing the basis. And then when you convert it into rental property, Armando, to answer your question, yes, you can now start depreciating it, even based on all the work you might have put into it previously. Now, the third thing I want to talk about, and maybe this is your question, can you depreciate it the years you lived in it? Well, first of all, you wouldn't really want to do that because now you're going backwards to get tax write-offs for 2 years ago, 3 years ago, 4 years ago, 5 years ago. Your depreciation begins the 27 and a half years, guys. That begins the year you put it into investment service. So let's say you buy a house and you live in it for 6 years, and then you move out of it. Let's say you bought it in the year 2020, and you move out of it in the year 2026. Your 27 and a half years begin year 2026. And now you get 27 and a half years where you get to keep on depreciating it. But bonus depreciation, yeah, that kind of depends on when you bought it. But again, for all of you guys, I can get somewhat general on these webinars and educational and whatnot. But if you have specific questions specific to your situation, and you're one of our clients, i.e. my team helps you buy and sell real estate, then I'm certainly happy to sit down and talk about your specific situation, what you can do, what you can't do. And then I always caveat by saying, verify it with a CPA, of course. But I'm happy to share my knowledge based on 15 years of being an investor myself, selling over $500 million in real estate, and certainly by having a master's degree in real estate, gives me a little bit of insight of what a person can do and what they can't do. Thank you all for joining tonight. I appreciate you all being on here. I love sharing knowledge, and I do believe that sharing knowledge is the #1 reason that my team has been successful. We've only been a team in San Diego for 5 years, but we have been sharing our information more than probably just about every real estate agent and real estate broker in San Diego. And I believe we share all that information because, one, we know more than most real estate agents and brokers. And number two, we share that information. And that's why we have a long list of loyal clients. And I hope that one day many of you will become our clients. So again, if you're interested in working with us or interested in learning more about how you can embark on real estate investing, best way to reach out to me is email patrick.kappel@compass.com, as you see in the top right of your screen. Thank you all for attending tonight. That concludes tonight's presentation, and I look forward to seeing you all soon. Have a good night.